What's going on, everyone? Charlie here. We have another filing to talk about out of the Securities and Exchange Commission. This is a summary of proposed rules for eliminating conflicts of interest between broker-dealers and their affiliated clients. Now, the Securities and Exchange Commission is proposing a new rule to eliminate certain conflicts of interest associated with broker-dealers or investment advisors' interactions with investors like you and me. The Commission is also proposing amendments to rules under the Exchange Act and Advisors Act that would require certain records in accordance with the proposed conflict rules. Proposed conflict rules include rules under the Exchange Act and 17 Code of Federal Regulations 275.204-2-2 under the Advisors Act. Proposed record-keeping amendments include Rules 17A-3 and 17A-4. And the proposal would require firms test covered technologies on an annual basis or at a minimum frequency. So the adoption and use of newer technologies such as predictive data analytics, or otherwise referred to in this document as PDA, by broker-dealers and investment advisors together have accelerated. Firms' use of PDA-like technologies can bring benefits in market access, efficiency, and returns. We believe the current regulatory framework should be updated to help ensure that firms appropriately address conflicts of interest associated with the use of such technology. So this is all, AI related, new tech frontier, industry 4.0. I put several videos on this out a while back. I wasn't kidding, and now we're here. Proposed conflicts rules would apply to clients and prospective clients of advisors and investors in pooled investment vehicles advised by those advisors. Broker-dealers and investment advisors operate within regulatory frameworks that in many cases require them to disclose, mitigate, or eliminate conflicts of interest. As the markets grow and evolve, as firms adopt and utilize newer technologies to interact with investors, we are evaluating our regulatory framework's effectiveness. Now, the presence of conflicts of interest between firms and investors is not new. Firms' increasing use of these PDA-like technologies in investor interactions may expose investors to unique risks. The effects of such unaddressed conflicts may be pernicious, according to the authors. The use of certain PDA-like technologies may create or transmit conflicts of interest that place a firm's interests ahead of investors' interests, authors say. Now, firms' use of technology to interact with investors and provide products and services has evolved significantly, and with it, the nature and extent of the conflicts of interest this use can create. We believe that firms are likely to increase their reliance on behavioral influencing when it comes to investor behavior. And in recent years, we have observed a rapid expansion in firms' reliance on technology and technology-based products and services. Some firms and investors in financial markets use new technologies such as AI, machine learning, NLP, and chatbot technologies to make investment decisions. Financial market participants currently use AI and machine learning technologies in a variety of ways. The advent and growth of services available on certain digital platforms, such as those offered by online brokerages and robo-advisors, Webull, have multiplied the opportunities for retail investors. Now, the rate at which PDA-like technologies continues to evolve is also increasing. Firms are exploring and deploying AI-based applications across different functions of their organizations. For example, Charles Schwab opened 142,000 new trading accounts in October, which is a 31% jump over September's pace, and this is as of 2022. Some robo-advisors use chatbot technologies for their online platform to provide investment advice and manage investment portfolios. Some chatbots have passed what is known as the Turing test and have become virtually indistinguishable from humans in particular situations. AI use is increasing year over year and in an array of different applications. Now, the use of artificial intelligence and machine learning. The use of this stuff by market participants and intermediaries and asset managers may be altering firms' business models. Some are using AI in a multitude of ways, including responding to customer inquiries, back office processes, quality control, risk management, client identification, and client identification. That's there twice. Others are developing investment advisory services based on PDA-like technologies. Firms' use of AI may already be exposing investors to these new types of risks, as well as the risk of conflicts of interest associated with these AI use. These risks will have broad consequences if AI makes decisions that favor the firm's interests and then rapidly deploys that information to investors. So they're basically saying the firms and investment advisors could use the AI decisions against the investors. They wouldn't do that, would they? Now, the authors propose rules to address conflicts of interest associated with the firm's use of PDA like technologies when interacting with investors that are contrary to the public interest, and the protection of investors is now underway. The use of AI based applications is currently transforming various functions within broker dealers. They say reliance on scalable, opaque technologies can result in operational challenges or shortcomings. Firms may use these tools to increase the quantity of information used to support investment ideas. Firms using these tools are subject to standards of conduct, among other regulatory obligations that already apply to such advice or recommendations. So, what this filing is doing, it's basically explaining why they're setting up these rules for firms and members and brokerages so that we don't have any of these conflicts of interest that could occur from these AI technologies. Now, this is interesting. In congressional hearings related to market events in January 2021, investor protection concerns were identified relating to the use of certain types of DEPs. The ability of PDA like technologies used in investor interactions can process data more quickly than humans, and the ability of technology to disseminate the resulting communications to a mass market. A recent enforcement action involving allegations that an advisor marketed that its no fee robo advisor portfolios were determined through a disciplined portfolio construction methodology, when in reality they allegedly were preset to hold a certain percent of assets in cash because the advisor's affiliate was guaranteed a certain amount of revenue at these levels. Poor data quality or skewed data could limit the learning capabilities of AI or machine learning systems. Now, the FINRA AI Commission, yes, this exists. The FINRA AI Commission issued a request for information and comment on the use of DEPs by investment dealers and brokers. The Commission says DEPs may be designed to encourage use of tools and methods used in connection with these DEPs. Request was issued in part to assist the Commission and by its staff in better understanding the market practices associated with the use of DEPs by firms. The Commission received over 2,300 public comments, including submissions provided through an online feedback flyer that accompanied the request. Commenters offered a wide range of perspectives on DEP purposes, providing information on how investors interact with them. Investor Advisory Committee on Ethical Guidelines for Artificial Intelligence and Algorithmic Models used by investment advisors. Basically, they've considered views received from the SEC on this topic involving ethical guidelines. DEPs may also influence investor decisions without investors being conscious of it, and that's a worry that I have and I'm concerned about when it comes to using these things for investment decisions. I would rather use it to increase productivity and modeling to make better investment decisions based on the results of those more enhanced models. The proposal is designed to address the conflicts of interest associated with firms' use of PDA with certain investor interactions. That's what this whole thing is about. The proposal is designed to be consistent with the Commission's prior actions regarding technological innovation. Historically, the Commission has reviewed the changing technology landscape, provided guidance, and, if necessary, amended its regulatory framework to protect investors while still allowing firms use of their technology to innovate and benefit investors. Now, the proposal is intended to be technology neutral. We are not seeking to identify which technologies a firm should or should not use. That's not the point. The proposal builds off existing legal standards and, as discussed throughout the release, is designed to address certain risks to investors associated with firms' use of certain technology in their interactions with investors, regardless of which such technology is used. So they're basically saying if you're going to be using AI technology with investors, they need to know what you're using, how you're using it, and how it's going to affect them. The proposal is designed to prevent firms' conflicts of interest from harming investors while allowing continued technological innovation in the industry. Proposed amendments to applicable record-keeping rules would require firms to make and keep records related to the requirements of proposed conflict rules. Now, the new proposals. The SEC has proposed a new rule under the Advisors Act to prohibit registered investment advisors from outsourcing certain services or functions without first meeting minimum requirements. The rule would apply to the use of PDA-like technologies that analyze investor behavior. So, social media surveillance, online chat forum surveillance, investor brokerage services surveillance. They have surveillance on all of us. And that's why last year I told everyone, if you're on social media, get off social media. They're surveying you, your interactions, your groups, your peers, your likes, your hashtags. They're storing all of this and they're going to use it against you. Now, are there certain investment related activities that may not be behaviors or outcomes that should be covered? Is either behavior or outcome overbroad? capturing activities beyond those intended by the definition? Should a different term, such as investment related cover technology, be used? These are questions that the SEC doesn't have answers to yet. Now, the proposed definition is sufficiently broad to encompass the wide variety of methods using current and future technologies that firms could use to interact with investors. And again, the proposal definition of investor interaction would include interactions that have been viewed as outside the scope of recommendations for broker dealers. An investment advisor making a recommendation to its client would also be subject to a fiduciary obligation that includes a duty of loyalty under which an advisor must eliminate or make full and fair disclosure of all conflicts of interest, which they won't. Now, a requirement to test each covered technology prior to its implementation, that's another clause in this rule, which is B1, it's going to require that these firms test each covered technology prior to its implementation or material modification, and periodically thereafter determine whether the use of such technology is associated with a conflict of interest. So again, do you see the general issue with these filings? They put the ball in the court of all of these people, the investment advisors that could have conflicts of interest, to have them ensure that none of this is going on. That's why they call these self-regulatory organizations, because they self-regulate. Now, testing may surface additional information that would not be apparent simply from reviewing the source code or documentation for the covered technology that these firms are using. Now, testing efforts. The majority of firms' testing efforts are when technology is first implemented or first deployed, or when it is substantially modified, and any periodic testing may focus on only a sampling of the firm's covered technologies. Firms that use complex covered technologies generally should use testing methodologies tailored to this complexity. Testing could also be used to aid compliance with other aspects of the proposed conflict rules. Is the proposed requirements to test covered technologies prior to materialization sufficiently clear? Should firms be able to test different covered technologies on different timeframes, depending on the specific risk of covered technologies as the proposed conflicts rules are proposed? Those are more questions the SEC does not have answers to yet. Now, the proposed conflicts rules would also include interests of firms' associated persons. Now, what challenges, if any, would firms face due to this aspect of proposed conflict rules? Should we limit the scope of the definition to conflicts of interest? I would say fuck no. Proposed conflicts rules would require firms to identify any conflict of interest associated with that use or potential use. Firms should consider carefully reviewing the outputs of such technologies to determine whether the firm interests are being placed ahead of investors. Determination. An advisor would still be required to disclose the conflict with sufficient specificity that a client could provide informed consent. Broker-dealer may bring general investment ideas to the attention of retail investors using an algorithm for selection, where some of the investments that may be selected would provide revenue to the firm if the investor places an order to purchase. Regulation BI adopting a release seeks comment on all aspects of the proposed conflict rules determining criteria. So again, if you have input that you want to provide to these documents and feel like you have a firm understanding what they're trying to do, where they're trying to go, you can go leave your public comment and give your thoughts on these documents. Don't forget that. I think that's basically it. In essence, this proposed investment advisor conflicts prohibition would only apply to registered investment advisors, registered or required to be registered under Section 203. Certain firms, including exempt reporting advisors and state registered advisors, would not be covered. Would certain types of advisors be disproportionately affected by this? A firm's failure to adopt and implement these policies and procedures would constitute a violation of the proposed conflicts rules, independent of any other securities law violation. We do not believe there is substantive difference between how firms would need to comply with each proposed rule. So essentially, they're going to be making sure that there's quote unquote rules in place to prevent conflicts of interest, but they're putting the ball in the court of the investment advisors to ensure that none of these conflicts of interest occur that could arise out of the new rising technologies when it comes to AI, chatbots, generative content, things like that. Very, very important, folks, to stay aware, stay smart, learn how to think for yourself, because if not, all these new tools are just going to be utilized to harvest more of your time, more of your attention, and leave you more confused than you probably are right now. It's just how it is. So start getting outside of all this. Use your brain, think critically, and leverage some of this technology to your advantage. Anyways, have a good one, folks.